Let's look at some important macro numbers that have come through. India's external trade deficit for goods fell to a 21-month low of about $15.24 billion. And this is thanks to a huge 14% fall in imports from a year ago, April. Exports are also down 12.7%, but the big outperformance yet again is the services export side. Latha is joining in with more perspective on this. So Latha, how should we read this fall in imports? Is that a cause of concern, perhaps?
The headlines can look dismal. If you say, oh, imports fell, which means our industry must be slowing, and exports have fallen 12.7, so destination countries, I mean, we're not going to do well. I think underneath these headlines lies a very strong story. And I'll tell you why. The goods trade deficit, ultimately we should worry whether we are importing too much more than what we are exporting. The trade deficit has actually shrunk to a 20-month low, and I'm only counting goods, at $15.26 billion. So the point is, imports have fallen much more than exports, a much larger quantum. Now, let's only analyze the export fall. Exports are down, yes, 12.7% from year ago and about 9.7% from month ago, from March levels. April is always lower than March. March is a larger month. But if you look at the exports, many of them, petro products, gems and jewelry, textiles have all fallen. All these are price points. Petro product prices have fallen, and that's why it's fallen. We should keep that in mind. The important point is, in spite of the global destination country slowdown, electronics exports are up 25%, which means this, Apple-related investments appear to be doing very well. Electronics exports up in a slowdown year for the world. Again, let us look at the details of the imports. Imports down 14%. Yes, not terribly good. It's 14% down from month ago and year ago levels. Now, again, look at the products. Imports of crude, coal, chemicals, edible oils are all down. Clearly, these are all price-led fall. And I would venture that it is not volume-led because of the next item. Machinery and metals imports are up 15%. Now, a country will consume so much capital goods only if the industry is ticking well. And that, I would say, is a very positive takeaway. And finally, of course, the shining star, services exports, they are up 25%. Now, this clearly is looking like India is becoming the back office of the world, probably because of higher wages in some of the Western countries, more of, risk, compliance, data and analytics is all getting done in India, and that explains that India's services exports are becoming actually recession-proof. Now, if you take the goods come services is a surplus. We did a surplus of $13.86 billion and a deficit of 15-odd billion in goods. Together, look at the deficit, it's hardly worth talking about. $1.38 billion, peanuts. It's a near zero trade deficit. And that means a lot of positives for macro policy making. I mean, you don't have to follow the Fed 1:1. You can take a different view because of your economy, and you will not fear that there will be a run on the rupee or dollars will run away from the country. On the contrary, I think dollars are chasing. Capital flows through FPIs are coming because India is turning out to be one of those few growth stories left in the world.
Okay, Latha, thank you so much for explaining that to us. And that's, one story where the real story is beyond the headlines, as you explained. That fantastic number on electronics exports and the fact that imports of heavy machinery and the capital goods equipment, that's still higher. So those are some very, very interesting trends. And thank you for explaining them to us.